We're joined now by Gallo. He's head of market analysis at Schneider Foreign Exchange. According to Bloomberg data, he's #1 when it comes to foreign exchange forecasting. Stephen, welcome to In Business. Do you expect a domino effect, the ratings agencies to go after the next ones post-Portugal to fall?
Yeah, well, that's very interesting, Margaret, that you mentioned the concept of domino effect, because the decline in the euro overnight in Asia and then into the London mooring today, and also the speed and the intensity with which the market has shifted focus from Greece onto Portugal suggests to me that there are many in the markets that are looking to play this perhaps next more acute phase of the European sovereign debt crisis vis-a-vis a sort of self-fulfilling spreading crisis. And what I mean by self-fulfilling is that there may not be any acute problems in Portugal so far, but if the market perceives that there are problems there, it starts to obviously express itself through the Portuguese bond market, and then suddenly you have much higher Portuguese bond yields on your hand, and then you have a crisis. So it becomes self-fulfilling. And it's a very dangerous situation, because if history is any guide, this is some of the these ingredients are some of the same ingredients that went into the ERM crisis in the early 1990s. So it's something that needs to be watched very closely, indeed.
But to be clear, you're not talking about market manipulation or short selling sort of begetting selling. You're talking about an event, Moody's coming out and triggering this domino.
Well, it's not so much Moody's, but it is how the market perceived what Moody's was saying and how the market responded to what Moody's was saying. So, in fact, there you have another an issue on the hands of policymakers have another issue on their hands, and that is the ratings agencies and the signaling mechanism that is providing to the markets based on what the ratings agency is saying. Now, I haven't looked at a single report which has suggested that Portugal will struggle to fund itself through 2014. As far as I've seen, every single report suggests that Portugal will have funding. But the markets are bidding up yields in Portuguese government debt. So clearly the market perceives a problem, or the market is vying for there to be a problem. And obviously, if Portuguese bond yields exceed expectations, it means that Portugal has to stay out of the markets for longer. And if Portugal has to stay out of the markets for longer, then you have the political risks which are associated with the fiscal transfers in Europe, and you've got a ballooning crisis on your hands. So I think that's the situation I'm looking at, and those are the downside risks facing the euro.
So what you're describing is a bearish case scenario for the euro. Why are we not seeing more selling?
Well, I think you're not seeing more selling because at the moment, I mean, obviously, from a short and medium-term perspective, the dollar is very fragile, and we have to get through these talks regarding the first phase of what I see as the U.S. sovereign debt crisis, and they will culminate, we expect, in early August. And I think that's one of the reasons why euro-dollar, despite the imminent risk of default or disorderly default in Europe, which is not obviously a risk in the United States, despite that imminent risk, euro-dollar is still trading above 140. And I think that's what we're looking at now.
It makes sense of this for me, because I hear you saying, you know, an almost crisis-like U.S. sovereign debt scenario here, but you're not looking at default. What does a panic look like to you as we get closer to July 22nd and then to August 2nd?
Well, you know, it all is going to depend on what the default, if indeed we're going to get some form of default in the United States, if it's going to not make good on some of its obligations. It all depends on what it's going to look like. It may well be the case that coupon payments for treasuries continue while other payments are suspended. And I think that will, you know, if indeed we don't have an agreement.
That's incredibly difficult to prioritize, though.
Yeah, no, absolutely. But, you know, look at it this way, Margaret. On the one hand, you have a risk of default in the Eurozone, an imminent risk of a disorderly default in the euro area. On the other hand, you don't have that risk in the United States, but what you do have is a much higher debt burden, a much more unwieldy debt burden. And based on the discussions coming out of Washington, it's very clear that politicians really don't know what to do about it. So it's a tale of two evils, really. On the one hand, default in Europe is more of a risk in the near term than in the United States, just disorderly default. But on the other hand, in aggregate, the euro area debt burden is actually a lot smaller than the U.S.'s. And the U.S. is really the big one. That is the risk-free rate, and that's the one we have to get through. That's the top link in this long chain of sovereign debt distress, I'm afraid.
Very quickly, ECB hikes rates as expected tomorrow. What happens?
I think it's very much priced in. I think what the fluctuations in the market will depend on is what Trichet does going forward with the forward-looking guidance. I think he'll keep the door open to further rate hikes further out in 2011, but he won't want to cement anything in stone.
All right. Thank you very much.